As we speak on Wednesday, January 7th, 2026, the live intraday price for supermicrocomputer, known as SMCI, is currently trading at $29.98, marking a decline of 1.81% since the opening bell. This follows a period of intense volatility, where the stock initially showed some strength after the previous session closed at $30.54. While the broader market is closely watching the tech sector, specifically the massive movements in NVIDIA stock and Apple stock, Supermicro is navigating a very specific set of circumstances that distinguish it from its peers. Most investors looking at the screen right now see a stock that has lost a significant portion of its value from previous highs, assuming the story is merely one of a cooling AI market. However, the reality that many are missing is a major strategic shift in how the company is securing its liquidity, specifically the recent news regarding a $2 billion senior revolving credit facility with JP Morgan Chase. This move suggests that while the equity price is struggling to find a floor, the institutional backing for the actual operations is strengthening in ways that the retail market hasn't fully digested yet. If you have been keeping an eye on the standard news cycle, the common belief is that the high growth days for this company are behind it due to the accounting and audit hurdles that surfaced late last year. The expectation is a slow, painful grind sideways. But the reality is that the company is currently expanding its manufacturing capacity to support the upcoming Vera Rubin and HGX Rubin platforms from NVIDIA. While everyone is talking about the hardware itself, the real story for 2026 is the adoption of direct liquid cooling technology. Management is betting heavily that over 30% of new data centers worldwide will transition to this tech within the next year. This is not just a minor update, it is a fundamental shift in how high-density computing is built. When you look at the daily swings we're seeing today, it reflects a tug-of-war between those who fear the historical governance issues and those who see a massive order backlog that currently exceeds $13 billion. The recent trading volume has been elevated, showing that institutional activity is far from stagnant. While some smaller players might be using the Robinhood app or other popular investing sites to move in and out of the stock, the big players are making more calculated moves. We are seeing a pattern where institutional holders like Vanguard and BlackRock remain committed, with institutional ownership sitting at roughly 55%. This stability is interesting when you compare it to the more speculative retail sentiment often found on a typical Robinhood stock trading forum. For those of you who manage your own portfolios through an individual brokerage or perhaps use more automated solutions like Schwab Intelligent Portfolios, the current price action of SMCI represents a classic case of a high-risk, high-reward scenario where the fundamentals of the AI infrastructure build-out are clashing with the internal corporate narrative. Take a look at the broader sector for a second. While NVIDIA stock continues to lead the way in chips, companies like Supermicro are the ones actually assembling the complex systems that make those chips usable at scale. This is where online investment becomes tricky. It's easy to buy into the trend, but it's much harder to pick the right provider. Right now, SMCI is trading at a price-to-earnings ratio of about 24, which is significantly lower than the industry average of 38. To some, this looks like a bargain. To others, it looks like a trap. The tension here is whether the company can hit its $36 billion revenue target for the 2026 fiscal year. If they even come close to that, the current valuation will look disconnected from reality. I want to hear from you on this specific point. Comment below how many shares of SMCI you currently hold and whether you are adding to your position at these levels or looking for an exit. Your perspective on these high volatility tech names really helps the community gauge the true sentiment of the retail side. Beyond the daily price movements, let's talk about the business model and why this company occupies such a unique spot. They are essentially a total IT solution provider. They don't just sell a box, they design the entire architecture of the server, from the motherboard to the cooling systems. In the past, they were known for being the fastest to market with the latest tech from Intel and AMD. That speed was their competitive advantage. However, the older reports show that as they grew, their margins began to feel the squeeze. The non-GAAP gross margin recently hovered around 9.5%, which was a point of concern for many analysts. The reality of the current situation is that the company is sacrificing some of that margin today to secure long-term partnerships with hyperscale clients. They are targeting 6 to 8 major customers this year, trying to move away from being a component seller to a primary infrastructure partner. When you look at your options for online investing, whether you use the Fidelity mobile app or the Interactive Brokers platform, you see a lot of data points that can be overwhelming. Fidelity investments and Fidelity brokerage accounts are great for long-term holds, but for a stock like this, you need to be watching the intraday charts. The volatility is so high that the daily range often exceeds 4 or 5%. Today's low was $29.43 and the high was $30.66. That's a massive spread for a company with an $18 billion market cap. It shows that there is no consensus on what this company is worth right now. Is it a legacy hardware maker, or is it the backbone of the next stage of computing? The future outlook for SMCI is largely tied to their upcoming earnings report on February 2nd. The market is expecting a massive recovery in sales, with some forecasts suggesting revenue could double in the second quarter compared to the first. This is the curiosity loop that keeps traders engaged. If they miss that mark, the floor could drop. But if they exceed it, we could see a squeeze that mimics some of the moves we have seen in SoFi or even Tesla stock during their peak recovery phases. The risk, of course, is the debt. They have about $1.9 billion in debt, which is growing as they build out those massive plants in Malaysia and Taiwan. For those using a SoFi robo-advisor or other automated investment help, these types of stocks usually get filtered out because of the high beta and risk profile. But for the self-investing crowd using a Fidelity trading platform or an Interactive Brokers account, the goal is to find the point where the market's fear has outpaced the actual operational risk. The recent $2 billion credit line with JP Morgan is a massive sign of confidence from the banking sector. Banks don't hand over that kind of liquidity to a company they think is going under. This is the deeper insight that often gets lost in the noise of daily price drops. If you are looking at the technicals, the stock is currently sitting at a major decision point. It has been in a falling trend for a few months, and today's move below the $30 mark is psychologically significant. Some traders are looking for a breakout above the $32 level to confirm a trend shift. Until then, it remains a show-me story. The company has to prove that it has moved past the internal control issues of last year and that it can execute on these massive orders. The backlog is there, the demand from AI data centers is there, but the execution is the big question mark. When we compare this to other opportunities like Fidelity ETFs or Fidelity mutual funds, we see a much safer path. But for those looking for direct exposure to the infrastructure of the next decade, SMCI is one of the few pure plays left. Even Interactive Brokers trading data shows a lot of interest in the options market for SMCI, suggesting that people are betting on a big move one way or the other. Whether you're using Robinhood crypto or Robinhood fractional shares to build a small position, or managing a large individual brokerage account, the key is to not get blinded by the hype or the hate. The business itself is solid in terms of its product offering. Their Super AI station, which was recently unveiled, claims to have 5 times the computing power of traditional systems. This is where they excel. They are engineers first. The problem has always been the administrative side of the house. If the new advisor, George Kao, and the rest of the management can tighten up the ship, the gap between the current reality of the stock price and the expectation of the company's potential could close very quickly. To wrap things up, the central insight for Supermicro today is that the market is punishing the stock for its past sins and current margin pressures, while the underlying business is actually securing the funding and the partnerships needed for a massive scale-up. The expectation is continued failure, but the reality is an aggressive expansion into liquid cooling and next-gen platforms. We have seen how this worked out for other tech giants in the past. It is never a straight line up. Always remember that while you can get investment help from many places, the ultimate decision comes down to your own analysis of risk versus reward. The contrast between the falling stock price and the rising order backlog is where the opportunity and the danger lies. Keep a close eye on those volume numbers and the upcoming February earnings. That will be the moment of truth for the 2026 outlook.
If you found this breakdown useful, make sure you are checking your Fidelity IRAs or wealth management accounts to see how your tech exposure is balanced. We will continue to track these movements as they happen. Would you like me to analyze the recent institutional buy-in patterns for SMCI, or perhaps compare its valuation to other server manufacturers like Dell or HPE?